For the first time since the year 2000, the S&P 500 earnings yield is less than the yield on a 3-month treasury bill. We saw 8 moments where this spread has gone negative since 1950, many of these occurring before considerable drawdowns in the stock market. The same signal also occurred in 1929, right before a multi-decade top in stocks. So what exactly is this signal? Why has it been so accurate at timing significant market corrections throughout history? And should we expect this signal to be followed by a large market drawdown today? Now, when this chart goes into negative territory below the zero line, it means the S&P 500 earnings yield is less than the 3-month treasury bill rate. But what is the earnings yield? The earnings yield is a concept that is used to determine how interesting it is to own a stock. It essentially calculates how much a company is earning in profit relative to the price of the stock, and then you multiply that by 100 to get the earnings yield. Now, this can be applied to the S&P 500 because we know what the earnings per share of the S&P 500 is, and we know what the price of the S&P 500 is. So if we divide the earnings of the S&P 500 by its price, and we multiply that by 100, it's going to give us the S&P 500 earnings yield. And we actually have data on the S&P 500 earnings yield going back to 1910, showing you how interesting or not interesting it's been to own the S&P 500 over time. You can see the cheapest stock market we've ever had was towards the end of the Great Depression, where the earnings yield of the S&P 500 reached a staggering 20%. That means if you were buying $100 worth of S&P 500 shares in 1932, it was generating $20 in profit every single year. So of course it was a fantastic moment to be an owner of corporations, as you could buy yourself a huge amount of profit generation per year for a very cheap price. And of course, the lower the earnings yield, like for example here in 1929 or in 1968 or in 1999, the less interesting it is to own the stock market because it means that earnings are very low relative to the price. Now you can see over the last 10-15 years, even since the year 2000, we've seen the earnings yield stay very low for quite some time. Now that is where knowing the cash yield is important, because over the last 10-15 years, the Fed funds rate has been near 0%. The Federal Reserve has kept short-term interest rates near zero since the global financial crisis. Now, these short-term rates are actually the yield that you get for holding cash, and the Fed sets that yield at each Fed meeting. And since 2009, the interest that you got for holding cash was basically zero. So when you actually compare the S&P 500 earnings yield to the short-term rate or the 3-month treasury bill rate that is set by the Federal Reserve, stocks have actually been pretty cheap between 2001 and 2021. The very low interest rates set by the Federal Reserve incentivized investors to hold stocks despite high valuations, because the S&P 500 earnings yield during that period was still lower than the yield that you got for holding cash. Now, of course, as you can see from this chart, all of this has changed very quickly over the last year. The Federal Reserve has raised short-term rates from 0% to above 5% now, significantly changing the macro landscape and how investors are incentivized for making certain decisions. Of course, investors have not adapted to this new reality yet, as earnings yield remain very low, indicating that investors are still willing to pay a lot for very little earnings, as earnings yields remain below 4% right now, near the levels we saw during the dot-com bubble. So if we look at the earnings yield against the 3-month treasury bill rate, we see the earnings yield is now lower than the yield you get for simply holding cash, which is a substantially different environment for the stock market to what we saw between 2003 and 2021. In fact, we've only seen 8 moments since 1950 where we saw this spread come down to the same level that we are now. And if you look at the median forward return of the S&P 500 following this signal, stocks yield near 0% return looking out 3 months, and stocks are typically negative looking out 6 to 12 months, which is of course substantially different to the type of returns you can expect from the S&P 500 on average. You can see the black lines here represent the average return of the S&P 500 on each time frame. So let's take a look at these episodes and understand which one of these is the most similar to today to understand whether we should be concerned about a large stock market correction in the near term. To do so, we're going to take a look at the signals that occurred after the Fed raised short-term interest rates significantly like today versus the signals where the Fed did not raise rates significantly. In 5 out of the 8 episodes, the Fed raised rates substantially before the signal occurred, and the other 3 occurred when the Fed wasn't raising the short-term rate in a big way. So considering that the Fed has raised short-term interest rates substantially today, let's look at those episodes first. So in each of these episodes, the Fed raised short-term interest rates violently in order to fight inflation. This caused the earnings yield relative to cash to go negative very quickly as the yield for cash went up dramatically, but investors did not adapt to this new reality straight away. In October of 1969, you had the signal trigger and stocks dropped around 20% following that signal. In October of 1973, you had the signal trigger and stocks dropped around 40% shortly after that signal was triggered. In August of 1980, you had this signal. Stocks continued moving a little bit higher in the near term, but that was quickly followed by a top and a pretty sustained bear market throughout 1981 to 1982, with stocks declining 26% peak to trough. In July 1990, right here, earnings yield went negative relative to cash, and stocks corrected around 20%. Now, in January 1999, earnings yield went negative. Stocks continued to move higher during the euphoric part of the dot-com bubble, which was then followed by a top and a vicious 50% bear market that is actually one of the most prolonged bear markets we've seen in modern financial history. So in all of these episodes, except 1999, stocks dropped following the signal. Of course, in 1999, they topped soon after. Now, the other 3 signals, 1983, 1987, and 1998, are quite different to today because the Fed was not raising rates here. In these episodes, the earnings yield went negative relative to the yield of cash, not because the Fed was raising rates, but because the S&P 500 was just rising too much too quickly. And we can see in these episodes, 1983, 1987, and 1998, the drawdowns in the stock market were often a lot more muted or a lot shorter in length than the other 5 episodes that we took a look at. Now, as we discussed at the beginning of the video, we also saw a similar development in 1929. This is a chart of the S&P 500 earnings yield minus the yield on the 3-month Treasury note. The spread plunged from around 8% all the way to 0% in October of 1929, right at the top of the stock market. Now, what's interesting in this episode is that the spread didn't actually go negative, which is why I wanted to take a look at this episode apart, because the market actually topped before the spread was able to go into negative territory like today. You can see here it is above the 0 line. What's also interesting about the 1929 episode is that the Fed raised short-term rates leading into that episode. So that again shows us that when the Fed is raising rates and the stock market is becoming very unattractive relative to cash, it significantly increases the odds of seeing a much larger drawdown in the market. Now, of course, nothing is guaranteed, and for example, in 1999, it took 1.5 years before the market actually topped. And part of that was fueled by the technology bubble at the time. You could say artificial intelligence today is leading to some similar feelings of euphoria in the market. It's also important to note that some of the signals, even after the Fed raised rates, like for example in 1990, were very muted, with only a very shallow correction following the reading and not really impacting the broader bullish structure of the secular bull market that was taking place between 1982 and 2000. So no signal is ever 100%, which is why we use a combination of different strategies to assess the risk reward of the stock market at gameoftrades.net, and why you should take this video and all other videos discussing financial markets with a grain of salt.